All right. And then this is a product that I actually just introduced this month. This is something that we had a lot of requests for in the past, and we're finally making it happen where we can do a true standalone bridge loan. Basically, in a sense, it's a true standalone bridge loan. Borrower is not required to complete their purchase transaction with LendSure. They may go anywhere that they please, any agency lender that will have that lower rate for them. And so they're not going to be locked into a 6-month EPO like they would on our bridge loan. They can, either buy the property outright, fully in cash, mixed with a little bit of that equity that they tap into with our standalone, and with their own assets. They can, fully purchase the house outright, or they can use our cash out as a down payment for a purchase financed by another lender of your choice.
Nick, why are you calling it bridge loan? In my mind, it's just simple cash out loan.
Exactly.
Why it has to be something to do with a bridge? Bridge when two properties are involved. They say that you don't need second property.
Yeah.
Yeah.
Like one loan
It's only a
blanket
year. It's
loan.
only a year loan.
No, I understand. So it's sounds like a private money loan up to 70% loan to value on owner-occupied property. So this is good for people who will not qualify for, and it's the same criteria. You just qualify based on equity, right?
Yeah, we're going to qualify based off of the property here. Again, the appraised value is going to be the determining factor for the underwrite. And, again, with this on the 1003, you just have to put their employment on there. And we're mainly just looking at the property, where it's located, how much equity is in that property.
I understand. Okay, so basically this is a cash out owner-occupied loan up to 70% loan to value, which will cost borrowers $9.75 in rate and 2.5% origination fee, which is like private money loan, but in different disguise and for owner-occupied properties. Yeah.
Yeah. And it's important to note, when you do go to that agency lender, if that's your choice, just keep in mind, have a conversation with the underwriter over there and ask, how are they going to calculate the DTI on our bridge loan? It should just be taxes and insurance impounded into that DTI calculation, and not the accrued interest, since that accrued interest is not something that's going to be long-term. It's only something that will be a factor for a month, 2 months, however long it takes to sell off their property. So that's one important note to make when you are going forward with.
Which can be confusing for purchase loan, because they would question this arithmetics, and it's better to stay with you guys. But at the same time, here you say that, why would I choose this program versus our other one, where I have 9.25 and I can go up to 75% loan to value? What's the advantage of this one?
And I feel like it mainly comes down to borrowers' necessities, right? If they're a little bit more rate conscious and they're looking for the product that's going to give them the lowest, best rate, then the reason why you'd want to go with the standalone bridge loan is so that you have the flexibility of being able to go to any agency lender of their choice. Now, if they weren't as rate sensitive, and they didn't mind being in one of our loans, then they could definitely stay and do the bridge with us.
I really see the standalone bridge, I think, is going to be for the example of downsizing, right? Where it's maybe elderly people that have done a good job of building up the equity in their current primary, and they're downsizing where they don't even need a new loan on the new primary. That's going to be where the standalone bridge comes into play. Or Nick's example, where they're more rate sensitive and, W-2 full doc, consistent employment and income history, where they think they should be something closer to the higher 5s or lower 6s, then you have the flexibility to go to a different lender for the purchase.
Yeah, okay, that's just something to bear in mind, yes. But why you, in previous case, 70% would cost 2 points in origination, and here you're charging 70%, 2.25.
So there's more risk on this loan from the lender perspective, because
there's no. So you can get, it's up to you to decide. Yes.
Yeah, because there's no property to cross default it to.
I
right?
understand.
Now,
That's okay.
now
Yeah.
it's more risk for the lender.
Yeah. So
So
it's
there is no early payoff. Let's say if we get this loan and the borrower will buy with all cash out other property and pay off your loan in 3 months or 2 months.
Yep.
There is
Perfectly
no,
fine.
there is nothing like you don't charge us or whatever.
Nope, no clawbacks, no EPO. It's meant to be paid back as soon as possible.
So it's actually it's good idea. See, if you have equity, you get this money quick. You just pay per diem 975. Okay, your origination fee, but you get cash offer for other property, and after you can do
Yeah.
the financing.
Yeah, I mean, there's a cost to doing business, right? There's a cost to getting the equity out of the home that hasn't sold yet, but you need to hope that that cost outweighs, the benefits that they're going to be having, right? By being non-contingent on the new purchase, or maybe they just identified that purchase property that they really want. They need to make that offer now, and they just need more time to sell the departure.